So now we will talk about the different types of accounts. We have something we call as the accounting equations. This equation says that the assets equals liabilities plus equity. In the next slides, we will get to know each of these more closely. Businesses use different types of asset accounts. Cash is the money a company has, coins, checks, and bank balances. Accounts receivable is money customers owe when they buy on credit. Prepaid accounts are payments made ahead of time, like prepaid rent or insurance, which later turn into expenses. Supplies are assets while they're unused, but once used, they become expenses. Notes receivable are written promises from others to pay us back in the future. Equipment like computers or machines are assets, but they lose value over time. That's depreciation. Buildings such as offices or factories are also assets and they depreciate as well. Land is an asset too, but it's kept separate from buildings. So assets can be cash, amounts owed to us, prepaid items, supplies, or long-term things like equipment, buildings, and land. Liabilities are what a company owes, claims that creditors have against the company's assets. Here are the main types. First, accounts payable that are promises to pay later, usually for goods or services bought on credit. Next, notes, payable that are written promises to pay a specific amount in the future. Next, accrued liabilities that are expenses the company owes but hasn't paid yet, like wages or taxes. And finally, unearned revenue, which is the money collected in advance for services or products not yet delivered. For example, when you pay for a 1-year magazine subscription, the publisher gets cash right away, but it's a liability until the magazines are delivered. Each issue reduces the liability and becomes revenue. Equity is the owner's share of the business after paying off debts. Equity changes because of 4 things: common stock, dividends, revenues, and expenses. When owners put money into the business, equity goes up. The increase to equity is recorded in an account titled common stock. When the business pays money back to owners, equity goes down. The decrease in equity is recorded in an account titled dividends. These accounts are not expenses of the business, they are simply the opposite of owner investments. Revenue's impact is when the business earns money from sales or services and equity goes up. And finally, when the business spends money to operate, equity goes down, so expenses always decrease equity. So in short, investments and revenues increase equity, while dividends and expenses decrease equity. So far, we've learned a lot about the foundations of accounting. We started with the purpose of accounting: to provide useful and trustworthy information for making decisions. We saw how accounting is the language of business, helping both internal users like managers and external users like investors and creditors. We then looked at the principles, assumptions, and constraints that form the framework of accounting, rules like measuring at actual cost, recognizing revenue when earned, and keeping business records separate from personal finances. We explored the 3 main categories in accounting. Assets are the resources a business owns, like cash, supplies, equipment, and land. Liabilities are what the business owes, such as accounts payable, notes payable, and unearned revenue. Equity, which is the owner's claim on the business. It goes up with investments and revenues and goes down with dividends and expenses. All of these pieces come together in one very important formula that is the foundation of accounting. That formula is called the accounting equation, and that's exactly where we're headed next. Here is the expanded form of this equation, in which we break down equity into 2 different parts: contributed capital, which is what owners invest, and retained earnings, which is the profit the company keeps. Retained earnings go up when the company earns revenue, and they go down when the company pays expenses or dividends. So when we expand the equation, it becomes assets equals liabilities plus common stock minus dividends plus revenues minus expenses. This expanded view shows us exactly how sales, costs, and dividends affect the owner's equity in the business. Now pause this video and practice with this table by filling in the empty cells. Let's solve this problem together using the accounting equation. At the beginning of the year, Addison Company has assets of $300,000 and equity of $100,000. Using the equation assets equals liabilities plus equity, we can figure out liabilities. 300,000 equals liabilities plus 100,000, so liabilities must be 200,000. Now during the year, assets increase by $80,000, so total assets become 380,000. Liabilities increase by $50,000, so liabilities become 250,000. Now let's plug this into the equation again. 380,000 equals 250,000 plus equity. To balance, equity must be $130,000. So the company's equity at the end of the year is $130,000. The key takeaway is when assets and liabilities change, equity adjusts to keep the accounting equation in balance. Let's solve this problem together using the accounting equation. At the beginning of the year, Addison Company has assets of $300,000 and equity of $100,000. Using the equation assets equals liabilities plus equity, we can figure out liabilities. 300,000 equals liabilities plus 100,000, so liabilities must be 200,000. Now during the year, assets increase by $80,000, so total assets become 380,000. Liabilities increase by $50,000, so liabilities become 250,000. Now let's plug this into the equation again. 380,000 equals 250,000 plus equity. To balance, equity must be 130,000. So the company's equity at the end of the year is $130,000. The key takeaway is when assets and liabilities change, equity adjusts to keep the accounting equation in balance. The next topic is double entry accounting. This type of accounting is used when you record accounting information in your accounting records. A T account is a simple tool we use to show how transactions affect accounts. It's shaped like the letter T. The left side is called the debit side, and the right side is called the credit side. Every transaction touches at least two accounts. One side gets a debit, and the other side gets a credit. For example, if a business buys supplies with cash, the supplies account increases, so we debit it. At the same time, cash decreases, so we credit it. T accounts help us quickly see the effects of transactions and keep the accounting equation in balance. Debits and credits are the backbone of accounting. But here's the key. They don't mean good or bad, profit or loss. They simply mean left and right. For assets, a debit makes them go up, while a credit makes them go down. For liabilities and equity, it's the opposite. Credits make them go up, and debits make them go down. Every transaction affects at least two accounts. One side gets a debit, the other side gets a credit, and they're always equal. This is double entry accounting, and it's what keeps the equation assets equals liabilities plus equity always in balance. Think of it like this. When you receive something, you debit that account. When you give something, you credit that account. For example, if you buy $200 of supplies with cash, you debit supplies and credit cash. So, debits and credits are just a system of directions that help us track increases and decreases consistently and keep everything balanced. Now, try to find how the debits and credits would work on the expanded accounting equation. Now that we've learned about debits and credits, let's talk about the idea of an account balance. An account balance is just the difference between all the increases and decreases in an account. For example, if we debit cash $36,100 because of the stock investment, revenue, and receivables, and later we credit cash $31,300 because we paid for supplies, equipment, salary, etc., the balance in the cash account is $4,800. So debits and credits tell us how accounts go up and down, and the account balance shows us what's left after all those changes. In other words, the balance is like the running total. It's what remains after we add the increases and subtract the decreases.